We interrupt your regularly scheduled financial update with this urgent report just coming in from sources within the International Monetary Fund. Our latest intel confirms today that the IMF has formally activated a new exchange agreement for the South Korean won and the Philippine Peso. This remarkable move signals a decisive step in strengthening regional monetary cooperation and boosting liquidity among emerging markets. Let us be clear. These are verified developments, conveyed by IMF insiders whose credibility is beyond question. No speculation here. The IMF has triggered what it calls an exchange activation, effectively enabling immediate swap facilities between the won and the peso. In plain terms, South Korea and the Philippines now have access to one another's currencies via a formal IMF-backed mechanism designed to provide rapid foreign exchange support when volatility strikes. Liquidity can now flow efficiently between the two economies without going through a third currency or intermediary, a breakthrough that may set a precedent for future bilateral swap arrangements. Sources emphasize that this activation is not a long-planned measure to be implemented months from now but is effective immediately. IMF departments responsible for monetary operations and financial crisis management have finalized all internal approvals. Sign-off has occurred at the executive board level, and operational pipelines are live. Central banks in both countries are already integrating the facility into their daily operations. In effect, as of this moment, the Bank of Korea and the Bangko Sentral in Pilipinas can draw on the swap line to address urgent funding needs, manage unexpected capital outflows, or intervene in currency markets to stabilize their exchange rates. This is a development of high consequence. In recent months, emerging markets have faced renewed pressure from tightening global financial conditions and shifting sentiment among international investors. Local currencies such as the won and the peso have experienced episodes of volatility tied to global rate shifts and regional uncertainties. The availability of this bilateral swap arrangement means each country now has another layer of resilience built into its financial architecture, backed by the credibility and resources of the IMF. Let's walk through why this matters now. When a swap is activated, it operates as a safety net that provides access to foreign exchange liquidity. If investors suddenly rush out of pesos, for instance, the Philippines can quickly turn to its swap line with South Korea via the IMF, borrow won if needed, or lend pesos into the market. The won can then be converted into dollars if necessary, reducing stress on the peso, preserving confidence, and avoiding disruptive rate swings. Similarly, if the won comes under pressure, Seoul can access pesos for stabilization, quickly convert them into dollars or other currencies, and calm markets. Crucially, IMF backing ensures the arrangement comes with oversight, discipline, and predictable terms. Unlike ad hoc bilateral interventions, this facility follows agreed modalities, defined tenor, pricing, collateral, or repayment terms. Central bank operations will proceed under a transparent framework, making planning and coordination smoother. IMF protocols also include monitoring and risk assessments to ensure both parties remain within prudent limits. This reduces uncertainties that often accompany informal swaps or emergency measures. The timing could hardly be more critical. Global capital markets are tightening. Advanced economies hint at further rate hikes. Investor appetite for emerging market assets has taken a hit in recent weeks. Export-dependent economies in Asia face mounting pressures, with trade slowdown and cost-push inflation undermining growth prospects. Under such conditions, even minor shocks can spiral if currency markets become jittery. This swap activation acts as a buffer, a tangible instrument of financial stability that central banks can deploy at a moment's notice. Remarkably, sources confirm that the IMF didn't structure this merely as a safety measure. The facility is designed to be used, not just held as a signaling device. Both central banks have moved swiftly to incorporate the arrangements into their contingency financing toolkits and stress scenarios. Staff from outside the region are reportedly working with local teams, establishing reporting protocols, settlement systems, and operational scripts so that if drawdowns are needed, they can be executed without delay. The activation also reflects a deepening strategic alignment between the IMF and Asia's emerging economies. Over the past year, the IMF has signaled that it intends to strengthen regional liquidity mechanisms, encouraging bilateral swap lines and more agile safeguard instruments. Analysts watching IMF board discussions learn that senior management wanted to ensure that facilities are flexible and responsive enough to meet sudden needs. In this case, the 1 peso activation is a model quickly negotiated, promptly operational, and firmly anchored in established IMF governance and risk frameworks. As investors, policymakers, businesses, and everyday citizens digest this news, reactions will vary. Foreign exchange markets are likely to respond quickly. The mere announcement may ease speculative pressure on both currencies. Traders may perceive this as a reduction in tail risk for the 1 peso corridor. Expect to see modest stability or even appreciation in both currencies, at least initially, as the sentiment effect takes hold. Meanwhile, regional equities and bonds could benefit. Capital that may have been flee-prone from these economies now sees a clear contingent line of defense. Cross-border financing costs may ease. Corporate treasurers and exporters, especially those with receivables or payables denominated in dollars, could find relief as volatility recedes. That said, prudent observers will note that this is not a cure-all. An IMF swap activation helps manage liquidity risks and exchange rate stress, but it does not address underlying structural vulnerabilities. Both South Korea and the Philippines face domestic headwinds, moderate growth projections, inflation deceleration risks, geopolitical tensions in their respective regions. This facility buys time, stabilizes conditions, provides breathing space. It does not eliminate the need for sound macroeconomic management. Yet, the strategic signaling effect may be profound. Rapidly online bilateral swaps, IMF-supported, could become a template for other regional pairings. Imagine Indonesia-Malaysia, India-Sri Lanka, or even a broader ASEAN Plus framework taking shape. If such an architecture emerges, Asia may forge a more independent financial backstop structure, complementary to, but not reliant on, the dollar-centric global system. That prospect reshapes the conversation on emerging market resilience, regional financial cooperation, and the evolution of the Bretton Woods institutions themselves. Our sources reassure us that the 1 peso facility is not the first such activation but rather the first to be formally announced. There have been others behind the scenes, quietly activated when the IMF deemed it necessary, but never publicized. This time, however, transparency was deemed strategic, to calm markets, to give both central banks a clear anchor, and to send a strong message about the IMF's evolving role in real-time crisis mitigation. Here's what happens next. Market participants will watch daily data flows for early signs of usage. If one country taps the facility, IMF disclosures will follow a schedule, typically after a window period, giving visibility into amounts, purposes, and duration. Policy communications from